The mathematics is as simply as this. The USA right now at historic low interest rates is barely collecting enough US tax revenues to cover its interest expense 100%, which means if interest rates rise, which they are likely to rise since the Fed is pushing short-term interest rates higher, the average funding rate for the USA is going to increase, and that will lead to higher interest expense, which will in turn lead to the organic growth of the US debt outstanding just because of interest.
In a bid to lower the 4-decade high inflation, the U.S. Federal Reserve has been raising the Fed funds rate, with more interest rate hikes expected before the year ends. So far, there have been 4 interest rate hikes in 2022. In March, the central bank raised the target for the Fed funds rate by a quarter point to 0.25% to 0.5%. It was the first rate hike since 2018. During the May 2022 meeting, the Federal Reserve announced the second consecutive rate hike, raising the target by half a point to 0.75% to 1%. It was the biggest rise in borrowing costs since 2000, but more jumbo hikes followed. As the inflation rate unexpectedly jumped to 41-year highs in June, the central bank increased the Fed funds rate by 75 basis points, a quarter point more than the 50 basis points experts predicted. It was followed by another 75 basis points hike in July, marking the 4th consecutive rate hike. It also pushed the target range to 2.25% to 2.5%, the highest level since 2019. But the central bank is far from finished, as inflation is still at 40-year highs. Though many experts believe that more interest rate hikes will plunge the economy into a recession, Federal Reserve Chair Jay Powell believes not doing anything about inflation will bring more pain to Americans. Some market experts like ARK Invest's Cathie Wood believe the U.S. is already in a recession, while others like former hedge fund manager and Bitcoin financial guru Greg Foss believe there are far greater consequences of more interest rate hikes for the world's largest economy. Please watch, share, and like this video as Foss speaks about the U.S. debt spiral and how the world's largest economy might be digging its own grave with more interest rate hikes. We love to hear from our viewers and subscribers. So ensure you drop your thoughts, comments, and observations in the comments section below and subscribe to the channel for more videos like this. Thanks and enjoy the video.
The USA collects $4 and change trillion annually in tax revenues. And mind you, that has been augmented lately because of nice capital gains increases in stocks and assets. They collect $4 trillion, and they have what's called they have their primary, they have a fixed cost base that includes entitlements and military spending. And the combination of entitlements and military spending is in the area of 3.6 trillion, which leaves the balance of the tax revenues to pay for the interest expense. Now, the USA has $30 trillion of outstanding debt, Joe. And right now, their average interest expense is about $400 billion annually, okay? But that's at historic lows. The average interest rate that they were paying, if you do 30 trillion divided by 400 billion, is around 1%. But that's likely to rise to 3%, right? Because the Fed funds rate is, U.S. 10-year rates are now, 10-year Treasury yield rates are now 3%. And the shape of the yield curve and the funding, the blended funding costs is going to cause interest expense to increase so that they will not even cover their interest obligations, expense obligations, with the residual tax revenues over entitlements and military spending. So it basically means that debt spiral is growing organically and can be quite severe if the Fed has to push rates significantly higher just because they're fighting inflation. It all leads to, my opinion, that quantitative easing, QE infinity, is in the offing. There's no other way to solve the debt spiral. And I want to throw this out. It's important because there's other people doing great research. So I mentioned James Lavish, Luke Groman, absolutely on the same page. What a lot of people fail to appreciate, Joe, and this, I spent my entire life trading credit, junk credit to be exact, If a corporation had the same financials as the USA, it would be rated triple C. Full stop. Full junk credit, triple C rated. That's pretty scary, isn't it? Because triple C rated corporations do not cover their interest expense, or cover their interest expense anywhere between 1 and 1.5 times. That's the USA right there. And it's soon to be covering it less than 1 full turn. This is not a good situation. It's very scary. The rating agencies give the benefit of the doubt and say, okay, well, these guys do have the ability to tax and they do have the ability to print money. But nonetheless, it's my opinion that the credit risk of sovereign nations is severely under, as we know, in my opinion, is Bitcoin. Bitcoin can be thought of as an insurance on misunderstood, and we need a solution. The solution is sovereign debt spirals. It's not a pretty picture. I just saw some math on Canada, my home country, in total debt to their GDP. So this is a global phenomenon today that put Canada in the bottom of, well, in the they were the top performer of the zombie nations in terms of ADA. It's extremely dangerous because once confidence is lost in the sovereign debt of a nation, it quickly cascades right through the markets, right into corporate lending, into structured products, into the commercial banks, and that's the beginning of the end, essentially.
As Greg Foss points out, digital assets and stores of value like Bitcoin provide a great safety net for everyone seeking to avoid this imminent collapse. While there might still be more faith in stronger currencies like the US dollar, citizens of countries with weaker currencies are catching on fast. Earlier in the year, the International Monetary Fund said that compared to the US dollar, the Nigerian naira has declined by 10.6% annually since 1973. Africa's largest economy is also experiencing a massive hike in prices. In July, inflation jumped to 19.6%, the highest level since September 2005. Annual average inflation and core inflation are also up at 16.8% and 16.3%, respectively. It's even worse in countries like Venezuela, Zimbabwe, Sudan, and Syria, where inflation has entered triple digits. This is why citizens in these countries are adopting cryptocurrencies fast. According to a Finder Crypto report, Nigeria is among the global top 3 countries in terms of crypto adoption. The report found that 27% of the country's adult internet users, or 58 million Nigerians, own cryptocurrencies. Even the IMF recognizes the fact that tens of millions of investors are using cryptocurrencies as a hedge against weaker currencies. The organization recently published a report titled Regulating Crypto. The right rules could provide a safe space for innovation. Crypto assets have been around for more than a decade, but it's only now that efforts to regulate them have moved to the top of the policy agenda, the report states. It also notes that cryptocurrencies have moved from being only niche products. It's only in the past few years that crypto assets have moved from being niche products in search of a purpose to having a more mainstream presence as speculative investments, hedges against weak currencies, and potential payment instruments. What do you think about the present state of the global economy and the role of cryptocurrencies in it all? Please drop your comments and observations below, and don't forget to smash the like button. Also, ensure you subscribe to the channel and turn on post notifications for more videos. Thanks for watching.